Good day, investors. Today we are taking a look at Devon Energy. We're going to look at its business model, how they make money. We're going to look if they have any competitive advantages. We are going to look at management, who owns the company. Are they good at their job? Do they have skin in the game? How do they get paid? And finally, we're going to look at the valuations. Am I buying the stock at a cheap enough price that I'm protected if things don't go perfectly? Really short, hydrocarbons, fossil fuels are still the majority of the energy mix in 2024. Natural gas is leading, but you have growth in oil, you have growth in coal. So OECD is kind of projected to be flat, going down, while non-OECD countries are driving growth in demand. And of course, global GDP and energy consumptions go hand in hand. And of course, this means, by the way, IEA numbers are kind of bear case, so they are always under projecting. That's just my take on it. But if you look at this, of course, no OECD going to drive demand, right? Because as you live better lives, you want to use more energy, right? So that's your economic tailwind in this sector. And if you look at Devon Energy Corporation is an upstream US oil and gas producer focused on onshore shale development. Its major assets are in the Delaware Basin, Williston Basin, and Eagle Ford and Anadarko Basin. Production is 72% liquids, mainly oil, and 28% natural gas, making cash flows primarily driven by oil. The company has a market cap of around 22 billion, pays a 2.7% dividend, and while performance over the past 5 years have been pretty good, the stock is down on the year and broadly in line with weaker oil prices, so they kind of tend to move with the oil price, at least historically. You can see that Devon Energy is clearly oil weighted. A lot of focus goes onto oil, with production optimization delivering an upside versus guidance. And on this during the same period, they also adjusted for the weaker oil prices, and they are actually underspending their capital expenditure guidance, which is great. Strategically, Devon focuses on operational excellence, high quality shale asset base, strict capital discipline, and to maintain a healthy leverage. We'll see their balance sheet in a bit. The company prioritizes shareholder returns over growth, which is, I think, great. So the company is at a stage where they went, okay, let's deleverage, let's have a healthier balance sheet, and let's pay our shareholders. There is no huge growth outlook. They also emphasize the free cash flow yield across different VTI scenarios, which signals that management's view is that the stock is underpriced and generates attractive returns even at lower oil prices. So 7% free cash flow at a 50 VTI is pretty good. It's not usual that you get this high of a free cash flow yield in a US oil company. All right, on the top chart, Devon Energy Corporation shows a relatively high debt to equity ratio of about 55% according to Q3 25, which is elevated compared to some peers that we've looked at so far. So total debt has also increased in recent years, reflecting some acquisitions in 21 and more. This is basically a more leveraged capital structure, even though leverage kind of stabilized in these two periods. Looking at the bottom chart, the sharp increase in shares outstanding from 2020 to 2021 reflects the VPX Energy merger, which materially transformed Devon's asset base. Through this transaction, Devon acquired high-quality US shale assets, primarily in the Delaware Basin and Williston Basin, significantly increasing scale, inventory depth, and oil weighting. So we'll see it on the next slide. Following the merger, the company's strategy clearly shifted. Since 2021, Devon has focused on free cash flow generation, buying back roughly 5.4% of shares outstanding, paying dividends. But although dividends have been volatile, reflecting variable dividend framework and the company's sensitivity to commodity price cycles. So basically, the company changed after this merger. All right, again, if you look at 2020 production and 2021 production, the VPX merger in 21 was a turning point for Devon Energy, adding large-scale, high-quality US shale, particularly in Delaware and Williston, and materially increasing the company's operational scale. So it became a larger company, of course, after a large merger. So following the merger, production stepped up sharply. So it's no surprise to anybody. While proved reserves also increased. So this is the orange, which kept reserve life relatively stable. So you have more reserves and then you have more production. You divide reserve by production. That's your reserve life. Higher output largely been offset by larger reserves, basically. That said, This is a shale-heavy portfolio, meaning reserves naturally deplete faster and require ongoing reinvestment to sustain production over time. But we have a good trajectory for their production. Okay, this is management. Executive compensation at Devon is strongly aligned with shareholders. So if you look at the CEO, 71% of his pay is long-term equity, and non-CEOs get non-executive. Yeah, they get also 68%. So it's good. And also what I really liked is this scorecard is amazing. So I'm seeing free cash flow, 25% weighting. You have return on capital employed, 25%, capex, total oil and gas production, health, safety, environment. Okay, blah blah blah. These two, but these are amazing. These are amazing. And of course, you see that free cash flow is prioritized over total oil and gas production. So that's the story here. Ownership on the bottom is predominantly institutional, no single controlling shareholder, and management collectively owns 4.5 million shares, so it's roughly just below 1% of outstanding shares, providing alignment without concentrated control and not that big of a skin in the game, although not terrible, right? Because if you're talking about a $22 billion company, 1% of that is what, 220 million. So that's pretty good skin in the game. All right. We can see that for 25, Devon Energy Corporation has repeatedly cut capex. So this is 25 estimate, bringing full year capex down about 425 million. Yeah, you have this. In line with weaker oil prices. So this shows that management is reactive, disciplined, and prioritizes free cash flow over volume. The 25 and 26 preliminary outlook indicate relative stable production of roughly this range. And with this capex 3, basically let's say 3.6 capex of total capital and break even below 45. Actually, my own calculating break even is also 45. So it's usually my break even is higher than what the company says, but this time we came in at the same number. These assumptions are the basis for my DCF model, reflecting conservative management guided outlook, and I'm usually using the midpoints. All right. So historically, Devon Energy, I'm going to look at the top chart here. Historically, Devon Energy shows volatile return on equity. So if you look at this, minus, plus, double digit high, really like 22 is insane, which is expected from a commodity driven business. The average ROE is 19%, looks solid, although it has been boosted by leverage, right? You have during the same period, pretty high leverage, 71%. If you only focus at post-merger 21, post-merger numbers, these are more solid, although these coincided with a strong oil environment, so keep that in mind. From a balance sheet perspective, liquidity is adequate but not pristine, so if you look at their current ratio, it's just below 100%. And if you look at their debt to equity of 55%, well, that is somewhat elevated versus peers, making balance sheet strength a clear risk, although not an immediate concern. This is supported by interest coverage ratio of 8.8 times as of 2025 Q3, which is comfortable but not outstandingly good. Okay, so for valuation, I use the management capex for 26. Yes, and then the guidance for 25, 26, and 27, 8, 9, I increased the capex to be more conservative, and production, I basically use the guidance of 25 and 26, and I keep flat everything. Furthermore, what I did is that I used a 10% discount rate, 2.5% cost inflation, reflecting Devon's shale-heavy profile, and this together, you get a discounted free cash flow value of around 62 per share, above the 2024's 10 cap, which is a 10% free cash flow yield, basically. And even above the 21 to 23 Q3 annualized. So this is the more recent 10 cap, so 10% free cash flow yield. So, of course, DCF implies a higher production than historical and disciplined capex and moderate oil price assumptions. So at the price to book, you also see around 1.5x. Valuations they're reasonable, and here actually valuations look cheap. So key risk remain in the end oil prices, of course. And then you have the share reinvestment risk. You have the limited outlook of their inventory. Can they continue operations? Do they have to do more acquisitions? And of course, the usual operational regulatory risks. So, but if you look only at this, you have a price of 36, and then you have basically all the values I calculate is above that. So technically you would have a margin of safety here. All right, to summarize, Devon is a US-focused shale-heavy upstream producer with a production mix of roughly 72% liquids, oil-heavy, and 28% nat gas. Cash flows are therefore highly sensitive to oil prices and US shale economics, right? It operates in a price taker industry with no structural pricing power. It's not the lowest cost producer, which would be an edge in a price taker business. Carries a weaker balance sheet than top tier peers, so look at an Exxon. And shale assets require continuous reinvestment due to faster decline rates. These factors limit moat strength and justify part of the valuation discount. So it looks like an Occidental with a cheaper valuation from the glance of this. Of course, Occidental has a Buffett 34% owner next to you. Management ownership is 0.73% of total shares, so that's like 1% of the 22 billion company. So like, what's that, like just below 200 million? I think that's good enough skin in the game, although not really heavy skin in the game. I mean, 200 million owned by management is pretty big, but it's not like they own 30% of the company. It's still good enough. But incentives overall are really well designed, with heavy weighting toward long-term equity and total shareholder returns because of that, right? So returns on equity historically have been strong, especially post-21 VPX merger. Notably, the 2025 Q3 year-to-date free cash flow, if you annualize that, it exceeds the 24 free cash flow. So I think 24 was, I should stop and go back. But I think it was like $3 billion or 2 something. And then 25 Q3 year-to-date annualized would be like $3.2 billion free cash flow, which is pretty decent, right? Despite weaker oil prices. Of course, this is pointing to operational strength and higher production efficiency, and they also produce more. So basically, lower oil prices were offset by higher production and economies of scale going down, getting better efficiency out. The stock screens very cheap for a US producer, but this reflects balance sheet risk, shale reinvestment needs, and of course the commodity exposure is there. Valuations look attractive both on a discounted free cash flow basis and a relative 10 cap basis, implying meaningful upside, though returns ultimately are driven by oil and gas prices. Okay, so here you can see Devon relative to the companies we've covered so far. Remember to apply different margin of safety expectations to each company based on their specific risk and qualitative characteristics. You have to keep in mind Devon is, let's say, relatively highly leveraged shale producer, and if you compare that with an ExxonMobil, maybe Exxon looks here that it's expensive and this is cheap and I should just buy the cheap one, but maybe ExxonMobil is a better investment over the long time because it has a pristine balance sheet and more mixed asset base. So that said, if you enjoyed this video, please like and subscribe. Leave a comment with the stock you would like me to cover. I'm collecting a list. I'm kind of slow. I do try to do one video maybe a day. So it takes time for me to catch up, but I do like the comments, and I usually pick the companies which multiple people comment about. So that said, thank you for watching, and I'll see you next time. Take care.